Water is no longer a quiet utility hidden in pipes and reservoirs. It has become a frontline asset in a warming landscape where droughts linger, cities swell, and old rights collide with new demands. In the American West, rivers run thin, farms compete with factories, and a single aquifer can reshape a town's budget. Investors are listening because scarcity creates price signals that ripple through agriculture, utilities, and industry. From Las Vegas to Los Angeles, communities are renegotiating what a reliable water supply costs, who pays, and who controls future access. This documentary explains why water rights sit at the center of modern risk. Water rights in the United States operate like a complex urban system of pipes and contracts. Under the prior appropriation doctrine, the oldest valid claims get priority during shortages, so a farmer with senior rights may still receive a share when a city demands more. Rights are not ownership of water in a bottle, they are a legal claim to a portion of future flows. As climate stress cuts supplies, states trade allocations, lease water, and price access. Banks and utilities buy rights as a way to hedge inflation and protect operations. In short, scarcity turns rights into tradable assets. To understand today's scarcity, you must trace the story of Western water. People settled arid lands by negotiating rights long before big data and stock markets. The 19th century brought the doctrine of prior appropriation, sometimes summarized as first in time, first in line. The 20th century layered on dams, canals, and interstate agreements that moved water hundreds of miles. The Colorado River Compact of 1922 divided the basin into upper and lower allocations, setting a framework still tested by drought. As cities grew, agriculture remained the largest user, often consuming more than 80% of available supplies in some basins. Markets are finally pricing water scarcity into portfolios, though the asset class remains embryonic. Utilities issue bonds tied to water projects, farmers hedge with forward contracts, and investors watch drought indicators as if they were energy prices. In California and the Southwest, irrigation districts auction allocations and water banks trade rights based on expected supply versus demand. The Nasdaq Veles California Water Index and similar baskets track water access as a commodity like oil or copper, attracting risk-tolerant money. Yet, liquidity is uneven, and regulatory risk can swing valuations. Supply disruptions, decaying infrastructure, and climate volatility intensify these market tremors. Who feels the squeeze first and hardest? Farmers irrigating parched fields, beverage makers relying on reliable supply chains, and power generators that cool plants with abundant water. Municipal utilities face higher operating costs and rate pressures as they invest in storage, desalination, and leakage controls. Insurance and banks increasingly price climate risk into credit terms for dams, pipelines, and water rights leases. Real estate in arid markets carries a water premium, while drought-stricken regions see farm layoffs and shifting crop mixes. Even technology firms can gain from smarter irrigation and leakage detection through sensors and data analytics. Public utilities, telecom, and manufacturing will adapt. Water scarcity does not stay contained in a single basin. It travels through politics and markets. Macro forces include population growth in the Southwest, agricultural subsidies that sustain distant crops, and aging infrastructure that loses per gallon to leaks. Climate change reshapes rainfall patterns, shrinking snowpack that feeds rivers for months. Interstate river governance tests cooperation as states argue over resources and allocations, while urban desalination plants become strategic assets in drought cycles. Global commodity markets sense water risk as a factor, pushing food prices higher. Energy generation and mining face higher costs when water is scarce, tightening the entire production chain. Smart money treats water as a slow but steady hedge against inflation and climate risk. Pension funds and infrastructure developers scout long-term water storage, pipeline projects, and desalination plants as high-quality cash flows. Asset owners blend private equity in water rights leases with public equity in water utilities to diversify risk across drought resilience. Banks finance upgrades to aging systems, while corporate treasuries buy water efficiency technology to lower risk of production disruption. Individual investors can access exposure through utility stocks, green bonds, and education around water risk in annual reports. The approach favors durability over explosive short-term gains. Yet the bear case is real. Water is not a risk-free hedge. It is a highly localized and politicized asset with uneven liquidity. Rights can be renegotiated by storms, droughts, or changes in interstate agreements, leaving investors with illiquid positions and squeezed margins. Value traps exist if storage projects underperform, or if technology reduces water intensity elsewhere. Over-reliance on a single watershed or a single seller creates concentration risk. Regulatory crackdowns, water trading restrictions, and drought relief programs can abruptly shift prices. In short, water markets invite opportunity but demand disciplined risk management. Without careful governance and diversification, losses can outpace gains quickly. Retail investors can participate with clear guardrails, diversify exposure, stick to established water infrastructure and utilities, and benchmark against inflation. Start with utility stocks, with strong balance sheets and water efficiency initiatives. Consider exchange-traded funds or mutual funds focused on infrastructure and climate resilience if available, and avoid concentration bets on a single region. Track drought indicators, reservoir levels, and regulatory rules for water rights. Use long-time horizons and set rules for loss limits. Keep liquidity ready to rebalance as climate data shifts. Stay informed through credible reports from the Bureau of Reclamation and reputable market data outlooks. Water rights are a test case for how societies price scarce resources in a modern economy. The core lesson is not that water is mythical, but that rights, contracts, and infrastructure determine who gets access when it matters most. Investors should monitor basins, be wary of concentrated exposure, and favor durable assets such as reservoirs, pipelines, and treatment plants. Policy shifts can create sudden risk or sudden upside, so stay diversified and disciplined. The outlook remains cautious but constructive for long-term holders. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.